Hi everyone, welcome back to another episode of the Accounting and Tax Help Desk. Today we're going to talk about the good news when you receive the money, the inherited money, and what we need to do. Inheriting money means receiving assets which someone passed away, if either through a will, trust, or any other legal process. Commonly inherited assets include cash, bank accounts, real estate, retirement account, investments, personal property. In the US, inherited money itself isn't taxable income, but certain inherited assets can trigger taxes later. Like for example, if you receive the house and then you sell it later, that's going to be subject to the capital gain. There are in some states there are some inherited tax, but there is no federal inherited tax. Just remember, when I'm saying that inherited tax means when you already received the assets, because there is some state tax available that some people are subject to the state tax. Like that is going to be very complex issues that it's need a different episode. But if, for example, your dad or someone is like their wealth is more than 14 million, and if they're married, if over 28 million, their wealth is subject to a state tax. After they pay a state tax, then when you receive the thing that you receive after a state tax is not taxable. Doesn't mean that the amount of the estate is not taxable. So there is a very complex issues with the state tax and estate planning that needs a different episode. But after all of those process and you receive the assets, it's not taxable to you when you receive the assets after you went through all of those process. Cash is pretty easy, no income tax when you receive it. Real estate, you usually get a step-up basis and no capital gain taxes, and the capital gain is maybe minimal if you sell it soon. And means what the step up means like you adjust the real estate price to the price when somebody died, and then you receive the real estate. Like for example, the person bought the property for $100,000 and then they passed, and then at that time that you receive the building, right now it's worth $500,000. So the cost of that building for you is going to be $500,000, not $50,000. So that's a good benefit, because you're not going to pay if you sell it for $550. You're not going to pay 550 minus 50 original cost. That's going to cost $500,000. You're just going to pay 550 minus 500,000. That is just 50,000. So step up basis, it just helped you a lot when the person inherited real estate. Retirement account usually taxable when you withdraw the funds, except Roth IRA that has its own requirements. Yeah, there are all these things. Okay, I owe income tax when I receive assets. That's not usually true. I can avoid all taxes if I sell right away. And again, depends on the situation. And then IRS doesn't know if I sell, then that's not true, because when the title passes and then if any sales transaction includes the 1099s, IRS have the record. The IRA tax has been changed because before the person who received the IRA accounts had options to postpone their distribution through the life, but now it's a requirement. They need to distribute within the 10 years, and if that's have a mandatory distribution from your IRA accounts. So somebody who passed away and they were already required to do that distribution during the year, and then you receive that fund, then you need to follow some regulations. So just consult with your CPA because you have different rules. You have option to do it through the 10 years. So there are a lot of different things that you can talk about it with your CPA. So if you receive a house, it's you do the step-up basis as we discussed. You adjust your house based on the current fair market value at the time of the death. Usually the best thing to do the first, if you inherited a house, do the appraisal. First thing to do, just do the appraisal. That's the best thing. Then you have, at that time of the death, you have the value of the building. That's going to be your basis. So then later, whatever you sell, minus cost of selling, minus any improvement that you did since the date of death, it's going to add up, and then your gain is going to be the amount that you sell minus cost of the selling, improvements minus the amount that we determined in the appraisal at the time of the death. Anything that owes from the taxpayer who passed away, you need to be paid first, and then you can distribute the money. If I want to talk about more about how to transfer the wealth, or the best thing is always try to be proactive and setting up a living trust. before things happen. Because if you don't set up the living trust and there is no beneficiaries, for example, for your retirement account, and all of these is going to be a chaos. Your case is going to be to probate. It's going to go through the long process, going to go through the legal costs, and then after that, and then they have to pay all of the taxes, and then court is going to appoint a executor, and then after all of those, you're entitled to the properties. In the other option, if you already have the living trust, the person who received the assets, it's going to be very easy transition. So it's more about the people who, it's not when you pass away, then the person who received the asset is going to be a much easier life. So it's about more thinking about the other people after your death. Yeah, it's like the best thing is like if you're having living trust, everything is going to be included in living trust, how to manage, how to distribute the income after the death. But if there is no written living trust, usually it's going to be again the court decision. Otherwise, it's going to be a lot of chaos between the family members, how to distribute the cash, how to distribute the rents. So first thing first, I think the best thing is have a living trust, to have a written agreement about how to distribute the cash and the income. But if there are multiple things, yes, there are a lot of actually estate planning, or you need to have a lot of good planning before for something like this happens, unfortunately. But in some cases, it can even save you $1 million for the people who inherit the assets. Like with the good estate planning, you cannot believe how you can save on taxes. If you have a living trust set up, you cannot believe how much it's going to make the life easier for people who receive the assets. So definitely, if you're in the situation that your wealth is more than 14 millions, if you're single, if you are a family, if your wealth is more than 28 million, definitely be proactive. Think about having estate planning, consult with the attorneys for estate planning, consult with the CPA, because it's going to save, in some cases, $1 million when you transfer the wealth. Because with the proper estate planning, how to gift, how to transfer wealth, it's very crucial, it's very complicated, so it needs to be done by combination of the attorneys and CPAs. In the other scenarios, again, setting up a living trust can have a huge impact on the people who receive the assets. How to have for your IRA accounts, make sure you have the proper beneficiaries. Otherwise, again, it's going to go through a lot of process. But again, you as a person who received inheritance, like let's say you have a family members that I know it's not in your control anymore, it's their decision. So make sure, if you for sure know that you're going to receive those assets, make sure talk to your loved one, the ones who's going to transfer their wealth with you, and make sure there's a proper planning involved. Make sure there is a living trust, make sure there is estate planning, make sure that person is taken care of, they already took care of their taxes and debt, and then when you receive all of those things, there is a very much easier process. And then make sure all of this happens before that the old elderly people go through the dementia and or something, because at that time it's very difficult from a legal standpoint to do the actions, because legally the attorney or CPA cannot, because at the end of the day it's their decision to transfer their wealth to you, so you cannot start a legal process to transfer the wealth. All of these things needs to happen before all of these dementia or Alzheimer's, these things happen. One of the big mistakes is not, it's before it happens, actually, when there is no planning, state planning, and they just doing the reactive to the situation. I received the asset, what I need to do. Now it's going to be subject to the state tax. So first thing first, be more proactive, communicate with the person who's going to transfer wealth with you. And then there are cases that there was no tax planning involved, but we help the client. We was protective. We predicting the situation, saying this is going to happen. Your asset is going to go through the state planning, and you're going to pay a lot of taxes. You need to think about it now. First, you need to have a written agreement before you go through the dementia or Alzheimer's, to make sure everything is transferred to the right person without any chaos. And then, fortunately, they did action. They started tax planning, estate planning. Unfortunately, and the things happened. The thing that we predicted happened, and the person went through the dementia, and then he passed away 2 years later. But because there was a proper tax planning, proper estate planning, everything was transferred correctly, and then the estate tax was minimized. So they prevented a lot of chaos, but just being proactive and did the things at the right time. For your securities or all of the investment accounts, take a appraisal from the broker account at the date of the death. All of these can help you with for stepping up to all of those assets base. So the number one advice first, look at the situation, how wealthy the person transferring money to you is. If they are wealthy, you and you don't know how wealthy they are, have some communication with them. Okay, I know you're gonna transfer this much to us, and then your wealth is that much. With proper state planning, you can save a lot of taxes for us. Um, so if they are wealthy, for sure, state planning, proper plan for transfer of wealth is crucial. If there is not wealthy, again, having a living, make sure there is a living trust in place. If there is no living trust, it's gonna be a chaos. You're not automatically entitled to those documents. Even if there is a will, again, it's going to go through the legal process. So the living trust, it makes life much easier. And then appraisal, doing the appraisal at the time of the death. But if you expect it in the future, yes, make sure there is a living trust, make sure there is estate planning if the person is wealthy, and make sure you consult with the CPA and attorney that everything is taken care of. So today we talk about what happens with inherited money. It's very crucial in some cases. Proper estate planning and having a living trust is very important. If you have any questions, please give us a call, and please like, subscribe, and leave a review comments and leave a 5-star and leave a review comments for our podcast. Thanks for listening to this episode, and I hope hear from you soon.